Good morning, students. Welcome back to the session on advanced accounting. So today we plan to continue with our discussion on AS22 to begin with. And after AS22, as we discussed, we'll be starting with the topics around revenue, which are considered to be very important. So we'll plan to cover AS9 and AS7, and let's see as to how the flow really goes. And accordingly, we'll plan our discussion today. Okay. So now, we touched upon this topic, Accounting Standard 22, yesterday as well, and we briefly discussed about the timing differences, okay, wherein we discussed as to what is an accounting income, what is the taxable income, and how do we get the timing differences. Yeah. Now, in terms of timing differences, we discussed that the deferred tax is required to be created. Now, let's try to understand about these timing differences a bit more, and then we'll look at one example also, with the help of which we'll just try to understand this concept of deferred tax in more detail. Now, as around the timing differences, we understand that these are those differences which arise between the accounting income or the taxable income. So this is one part. Plus, such differences should also be the one which get reversed in the future periods. Okay. So of course, so we are talking about differences between taxable income and accounting income. But the another important point is that such differences should get reversed, okay, in the future periods. Yeah. And for this, we discussed that depreciation could be one example. And for depreciation, we discussed that under the books of accounts, we follow useful life, which is different from the rates of depreciation prescribed by income tax. Yeah. Now, with the help of same example on depreciation, we'll just now try to understand deferred tax. We'll also try to compute deferred tax. And then we'll assess as to why deferred tax is required to be created. How is this created? How does it really help in terms of preparation of the books of accounts? Okay. So I'll just share one working file now. All right, so let's look at it. Look at this example. Now, in this example, there is an item of property, plant and equipment. Okay. Amount of that item is what? 100. In the books of accounts, life of this PPE item has been considered to be 10 years. Fine. And you can consider SLM. Therefore, depreciation has been computed as 10 per annum. So if you look at this, this is what you get the depreciation. Year on year, this is the amount of depreciation. So over a period of 10 years, what do you find? That this asset is fully depreciated. So we may ignore residual value, etc. Yeah. So over a period of 10 years, this asset is fully depreciated. Fine. Then the WDV is also computed for this asset at the end of every year. Yeah. So these are years, you can say. So let me just write this for you. These are years, or you can say end of year. Fine. Now, let's go to income tax. Now, let us assume, now for the purposes of just solving this question, let us assume that under income tax, 20 will be the amount of depreciation every year. Okay, because the rate regime will apply, and forget this written down value method or SLM method. I'm just giving you the amount of depreciation. So let's suppose over a period of 5 years, 20 depreciation will be charged or will be allowed as per income tax. Okay. Now, if the amount of depreciation as per income tax happens to be rupees 20 year on year, starting from year 1, then over a period of 5 years, what do you find? This asset will get fully depreciated. Okay. So let us take this total of depreciation under income tax also. Yeah. Now, as around depreciation, what do you find under the books of accounts as well as income tax? That if you look at the life of the asset, then over the life of the asset, depreciation charge will remain the same. Depreciation charge will remain the same. However, if you look at the depreciation charge year on year, okay, so if you look at first year, depreciation charge as per books is 10, as per income tax is 20. Again, the same thing is repeated in second year. Again, the same thing is repeated in third year, and so on it continues. Okay, now let us try to compute this difference. Let us try to compute this difference. Just give me a minute. So if we compute this difference, okay, and the difference which I'm talking about happens to be the difference between the depreciation as per books and the depreciation as per income tax. So in the first year, what do you find? In the first year, you find that in the books, depreciation amount is lower. Okay. However, as per income tax, depreciation amount which is allowed is higher. Okay, so that's why we are getting a difference of 10. Okay, now same thing is there in second year, same thing is there in third year. If you look at fifth year, up to fifth year, same trend continues. Yes or no? Same trend continues. Now, if you go to sixth year, in the sixth year, now there is a change in this trend. What do you find? That in the books, depreciation for this asset is taken as rupees 10, but under income tax, now the amount of depreciation is 0. Okay, so no depreciation is allowed as per income tax. Okay, it has become 0. Now the same thing is there in year 7, same thing is there in year 8, and this trend continues. Fine. Now, let us try to understand the impact which this sort of situation is going to create. In the first year, as per income tax, depreciation allowed is more. Okay. In the second year, as per income tax, depreciation allowed is more. Okay. So that's why what do you find? Over a period of 5 years, income tax is allowing higher depreciation charge. Yeah. But starting from 6th year, what do you find? That this depreciation charge, which was allowed by income tax in the previous years, is now disallowed. That's why you see a reversal of this trend. That's why you see a reversal of this trend. Correct? Now, in terms of this impact in the first year, let us try to understand as to how this is going to impact the tax provision or the tax liability of this company. In the first year, what will happen? Company will go with a profit after charging depreciation of rupees 10 in the books of accounts. Okay. But when it comes to income tax will disallow this depreciation. Income tax will disallow this depreciation. Yes or no? Yeah. And as against this depreciation, income tax will allow depreciation of rupees 20. Therefore, in the first year, what will happen? Company will pay lower tax. Yes or no? In the first year, company will pay lower tax. Why? Because company will have to pay tax as per the taxable profits, not as per the accounting profit. But the taxable profit in the first year will be lower. Yes or no? Same thing, if you look at second year, tax liability will be lower. Third year, tax liability will be lower. Fourth year, fifth year. Now the same trend continues over a period of 5 years. Over a period of 5 years, same trend continues. But we now need to find out whether this trend is permanent or not. So what do you find in year 6? That now there is a reversal. Now what is the impact? In the 6th year, income tax is not allowing any depreciation charge. So we were feeling happier that in the first 5 years, income tax is allowing more depreciation. So thereby we are required to pay lower taxes. But does it continue forever? The answer is no. It stops and it starts getting reversed if you look at year number 6. So what do you find in year 6? In year 6, income tax has disallowed the depreciation amount. But in the books, a depreciation of rupees 10 was charged. In the books, a depreciation of rupees 10 was charged. So now what do you do with this depreciation of rupees 10? This doesn't help. Why? Because the tax will have to be paid on the taxable profits, not on the accounting profits. Okay. So now what do you find? That in year 6, the tax liability for this company goes up. Okay, this goes up. Same thing if you look at 7th year, 8th year, 9th year, 10th year. In all of these years, now the same trend continues. Same trend continues. Yeah. So now, what do you say about this trend which we find in year 7 to 10? It's effectively a reversal of what we have seen in year 1. So year 1, tax liability was lower, but actually that is not lower forever. We can say in a way, tax on this difference of rupees 10 got deferred to future years. Yes or no? This tax amount or this tax liability, this did not go down. This actually got deferred to the future years. And which future year was that? Starting from year 6. Starting from year 6, as we can see. Now, same is the case for year 2. Same is the case for year 3. Same is the case for year 4. Same is the case for year 5. Yeah. So now in this case, if the company is in year 1, yeah. So now on this rupees 10 in year 1, when the company is not paying the tax liability, okay, when the company is not paying the tax liability. So now what do the company needs to do? Company knows this fact that this tax liability has not gone down forever. This has only got deferred. This has only got deferred. So this tax liability is going to be, paid. But in year 6, in year 7, in future years. So that's why, what do we need to do? We need to create a provision. We need to create a provision in respect of this tax liability also, which has been deferred to future years. So how do you create this tax liability? Same way, on this difference, we need to create the deferred tax. And how do you create the deferred tax? On the timing difference, we need to multiply the tax rate. So let's suppose the tax rate is 30%. Assuming, okay, assuming that to be 30%. So now what do you get? Tax amount of rupees 3 in year 1. In year 2, this gets added by another 3. So that's why on a cumulative basis, what does it become? 6. In year 3, on a cumulative basis, it becomes 9. Yeah. And up to year 5, on a cumulative basis, this becomes 15. This becomes 15. Okay. Now, in year 6, now what do you find? In year 6, this liability starts getting paid. So you can say this deferred tax liability, which was created by the company in year 1, 2, up to 5, this is now getting released. And thereby, the amount of this liability, which we had at an amount of rupees 15 up to the end of year 5, now goes down to 12. And this way, if you look at the end of 10th year, this becomes 0. This becomes 0. Okay. So now this is the rationale for creation of deferred tax. So whenever we have any timing difference, what is it that we need to check? We need to check whether this difference is something which is permanent in nature or which is only a timing difference. Now, how do you check that? If you look at this difference, okay, so now if you look at this difference over a period of 10 years, what do you find? It becomes 0. So let's take a total of this. Over a period of 10 years, what does happen? What does it create? It creates 0 impact. Okay, over a period of 10 years, this difference is 0. So that's why, what do you say? That over the life of the asset, even though some differences are originating, but they are also getting reversed during the life of the asset. And that's why these differences are termed as timing differences. And we have a very simple formula for creation of deferred tax. What is that? Whenever there is a timing difference, multiply tax rate and you get the deferred tax. Okay, clear on this? Yeah. Any questions so far? Any questions on this? I think Srinivasan has a question. He's asking, provision for tax and current tax are the same thing? Yes, absolutely. They are same. And we'll discuss that. Okay. We'll look at some accounting entries also. And I'll explain you as to what is a provision for tax, what is deferred tax, what accounting entries you'll pass. Okay. All of these things we'll discuss. Yeah. Any more questions from your side? Anyone else? Any doubts? Do you think you're clear on this? On the deferred tax concept? Yeah, it's very, very important. And at times I've seen this becomes tricky for the students. Huh? So once you understand the concept, you'll not find this difficult. Any questions on this? Any doubts if you have? Quickly. Any questions on this? Rashmi seems to be clear on this. Okay, what about others? Okay, I think Srinivasan has a query. He's asking, sir, in P&L, you will see current tax and deferred tax under the tax expense. Can you please explain in the context of deferred tax liability and deferred tax asset, how it will be recorded in the P&L? Yes, sure. We'll discuss that. That's what I'm telling you. Huh? Okay, what about others? Anyone else? Any more queries? All right, so let's move further on this. Now, let's try to look at the accounting entry for this. Now, in the first year, what will be the accounting entry? Now, in this case, deferred tax liability is required to be created. And why do you think it will be a deferred tax liability? Anyone from your side? Why do you think it will be a deferred tax liability in year 1? Over to you. Anyone? Can you tell me that in the first year? Okay, so I think Baswant has a query. He's asking, sir, in the first year, liability or asset? No, the same question is there from my side. Let me just see who can answer this. Okay, Rashmi is saying, I have doubt around the permanent differences, saving of tax. No, sure. I'll talk about it. And I think she's talking about this. She's saying that because there is a saving of tax in the first year. Okay. Then Srinivasan is saying because expenditure is reduced. Okay. Now, in the first year, let's try to understand this conceptually. Okay, which is also the query of Baswant. Now, whether it should be a deferred tax liability or asset. See, one point we have understood that deferred tax will be created. Why? Because there is a timing difference. But the other point which generally bothers us happens to be the fact that in respect of this deferred tax, should we create an asset or a liability? Okay. Yeah, that's the concern to most of us. So let's try to understand as to what is the methodology we need to follow in respect of accounting of this deferred tax and to assess whether it will become an asset or a liability. See, when it comes to the end of the year, at the end of the year, company saved tax. If you look at this difference of rupees 10, on rupees 10, company did not pay tax. Company did not pay tax. Now, can we say that this saving of tax is permanent? No. So actually, what has happened? This rupees 3 of tax, which the company did not pay in the first year, company will be required to pay this in the future years. So that's why, as on today, there is an incidence of tax. There is an incidence of tax whose cash outflow is going to arise in future years. Yes or no? So today, if you look at it from tax perspective, what is it that the company has done? Company has got into a situation wherein it is not paying tax today, it will be required to pay it later on in future years. So that's why this rupees 3 is what? It's the tax outgo which is going to happen in future years. So if you look at it from tax perspective, this rupees 3 will be required to be paid by the company in future years. Okay. So if in future years, company will be required to pay, so what does it become? Liability. Yes or no? What does it become? Liability. So that's why, what will be the accounting entry? So the company will say to deferred tax liability 3. Okay. Now, liability is recognized, but where will this impact go? This impact will go to P&L after tax. Okay. In terms of P&L, when I'm saying after tax, means this will be a part of the tax component. Means after PBT, this will arise. So now this will go to P&L, and in the P&L, what is the nomenclature you will assign to this? Very simple. We can say it's the deferred tax expense. So the company will say deferred tax expense debit 3 to deferred tax liability 3, wherein this deferred tax expense, where do you take it? This will go to P&L. Okay, this will go to P&L. And this deferred tax liability, where do you take it? This will go to balance sheet. Understood? Yeah. So this is how accounting entry will be passed. Now let me just look at some of your queries. Rashmi is asking deferred tax liability. It means actually no benefit of any deduction and exemption. Yes. This benefit, even though it appears to be a benefit, is not permanent. It's only a deferment. Okay. So as of now, what is the company doing? They are only deferring their tax liability. So you don't really call it as a benefit. Yeah. It's only about deferment. Okay. Then Shivanna is asking, sir, is it applicable only on depreciation or will it also apply to other disallowances or allowances? See, depreciation is only an example. This will apply to any such item over which there is a difference between books of accounts and the taxation requirements, plus which are going to originate in one year and which will get reversed in future years. Yeah. So there could be various examples for this. For example, if we look at the items which are there under section 43B, okay, of the income tax, okay, those are also some of the examples which will fall over here. Then Anit has a query. Anit is asking, but this we estimated PPE, but the tax is not estimated in terms of future. Then how can we understand the deferred tax? See, it's very simple. In terms of this rupees 10, in terms of this rupees 10, we are very clear there is a difference. In fact, this is not only an estimate. In fact, this is not an estimate. This is the exact amount. This difference of rupees 10 is the exact amount. So we should not really call it as an estimate. And on this rupees 10, we are also aware of the tax rate. Yeah. At one point, we can say that we are not aware of the tax rate at which this tax outgo will happen. But as of now, we all understand as to what is going to be the tax rate in the future years. Okay, at least for the next year. So that tax rate you will consider, and accordingly you will create this deferred tax, whether it results in a deferred tax liability or a deferred tax asset. It could be either way. Okay, yeah. Now, similar to this deferred tax liability situation, there can also be a situation which may result into deferred tax asset. Now, what could that situation be? So let's suppose if we reverse this. Okay, so if we say that instead of this reduced tax amount which has been paid in the year one, if the company has paid more tax, let's suppose in year one, it's other way around. Let's suppose in year one, company is required to pay more tax. Why? Because let's suppose income tax is saying depreciation is 10 and books of accounts are saying depreciation is 20. So what will happen? What will happen? Company will pay more tax in year one. But this additional tax in a way, or this higher tax in a way, which the company will be paying in year one, now will it again be a kind of permanent difference? No. Why? Because this will also reverse. This will also reverse in the future years. And when this will reverse in the future years, what is going to happen? The higher tax amount which the company would have paid in the first year will get reversed in a way that the company will be required to pay lower tax amount in the future years. Company will be required to pay lower tax amount in the future years. Okay. And if that will happen, what do you call it as? You will call it as a deferred tax asset. Okay. So now let's suppose if this was recognized as a deferred tax asset. Okay. Now, what is the accounting entry you will pass? Can you tell me for deferred tax asset, if you were to recognize that, what is the accounting entry you will pass? Quickly, over to you. Okay, so then in the meantime, I have this query from Baswant. He's asking, sir, in the third year, if we changed method of depreciation from SLM to WDV, how do we treat this? See, very simple. It doesn't really matter as to what methodology you have been following. You need to just simply go by the numbers. In the books, whatever is your depreciation amount, you will place here. And as per tax, whatever is your depreciation amount, you will place here. And you will compute the difference. Okay. Whether you are changing method, whether the life is changing, all of these aspects, don't get into that complexity. Okay. That will only confuse you. Keep it very, very simple. You will place the numbers, you will compare these, and you will also check whether these are reversible in future years or not. And that is how you need to approach this. Okay. So Rashmi is saying it will be DTA to income tax. Okay. Pooja is saying DTA debit to deferred tax expense. Okay. Anyone else? Yeah. So let's look at this accounting entry, which the company will be required to pass if in case this is recorded as DTA. So now deferred tax asset will be debited because it's an asset. So what do you debit? Deferred tax asset, and its corresponding impact will also go to P&L. Yeah, its corresponding impact will also go to P&L. But now in the P&L, what do you call it as? Will it be an expense? No, because if the asset is recognized, then you will not have an expense. Then it will be income. Then it will be income. So what do you call it as? You will call it as a deferred tax credit. Okay, deferred tax credit. Fine. Now, I think same was the response from Shivanna. Very good. And Unni Krishnan had the same response. Okay, great. Let me just see who has answered this. Okay, so I think Rashmi answered this, Sentu also, Pratima. Okay, yeah. See, like you mentioned, we can also credit deferred tax expense, but when you credit deferred tax expense, in a way that becomes income, okay, which you call it as credit. Okay, so that's the nomenclature you use. Fine. Now, let's try to quickly discuss about the tax expense. Okay. Now, in the P&L, so let me just put down P&L. So let's suppose there is a statement of P&L. Okay, statement of P&L. Now, in the statement of P&L, what will you have? You will have revenue, X amount. Then you will have expenses. I'm just not putting down the list of all of those expenses. And then you'll have PBT, TBT, correct? And then the tax expense will be recorded. And then, of course, you'll have PAT. Okay. So now, in terms of now, what do you mean by this tax expense, or what does this tax expense really comprise of? Now, tax expense, as we discussed, comprises of two elements always. For a company in the current year, some provision for tax will have to be created. Yes or no? Yeah. In respect of the items on which tax consequence is going to arise in the current year itself. I'm not saying the tax consequence will arise in the future years, like it happens in case of deferred tax. Tax consequence arises in the current year itself. What do you call it as? That is called as current tax. And very popularly, this is also called as provision for tax. Okay, current tax and provision for tax are one and the same thing. So what do they indicate? They indicate the tax liability which the company will be required to pay for the current year. Okay. Now, let us suppose this is some X amount. Yeah. On the top of it, what do you also need to add to tax expense is the deferred tax. So let's suppose tax liability for the current year is 100. So let me just put down some number over here. Say this was current tax or provision for tax is 100. And let's suppose this deferred tax results in a liability. So what will you have? You will have deferred tax expense. Yeah. Deferred tax expense of 3, something which we have computed in our example also. Yeah. So now, what is going to be the total tax expense for this company? This will be 103. This will be 103. Okay. And where do you take this total tax expense? This total tax expense of the company will go here. Okay. Yeah. So this is what you report in terms of total tax expense. Understood? Yeah. So this is what you record under total tax expense. Now, let us say, for example, instead of deferred tax liability, if the company would have recorded a deferred tax asset, let's suppose the company would have recorded a deferred tax asset instead of a liability. Then let's try to understand as to how this tax expense would have changed. So the current tax amount would have remained same. Yeah. But this deferred tax expense will now be a credit. So now, do you present it under income separately? No. You will net off that income or credit from the tax expense itself, like this, like this. And where will this amount go? This amount again is something which you call as tax expense. Okay. Now, please understand that tax expense is a composition or comprises of two elements. What are those two elements? Current tax, or you can say provision for tax. And second one is what? Deferred tax. Now, deferred tax would be an expense or the credit. Understood? Yeah. I'm hoping that Srinivasan, your query is now clear. Okay, so Srinivasan is asking about income tax paid and its effect in the P&L balance sheet. So this is the effect of the income tax in terms of deferred tax. Yeah, in the balance sheet. So we have discussed as to where does it go. So when the deferred tax is there, it will have both the impacts. One leg will go to P&L, other leg will go to balance sheet. So this is how it will be shown. And this is how it will be presented in the statement of P&L. Okay. Then I think Rashmi also answered both this. Okay, so Pooja is asking about the Excel sheet. So I'm just hoping that this file is visible to all. I think Pooja is facing some challenges. Can you please quickly confirm everyone? Is this file visible? Yeah, is the screen visible to everyone? Quickly. And in the meantime, if you have any questions, any doubts, please confirm. I think Pooja, you need to check at your end. There could be some connectivity issue because I think Bhumika, Nidhi, everybody is confirming that yes, this is clearly visible. Okay, great. Great. Any more questions on this? See, this is about deferred tax as to why do you create deferred tax, how this is created, how this is presented in the balance sheet as well as P&L. Okay. And whether you create a deferred tax asset or a deferred tax liability and under what situations you will do this. All right. Yeah. Okay, so now Srinivasan is asking, sir, income tax paid is different from the tax expense? Yes. See, income tax paid is what? Now, in this example, this tax expense, let's suppose that we have recorded. Okay. Now, corresponding to this tax expense, there will be a liability also. Yes or no? There will be a liability. And this deferred tax expense, we also discussed there will be a liability. So all in all, there will be a liability of 103. Yeah. Now, whenever you pay this amount of 100, this 3 we understand will be paid in future years. But this 100 will be paid very soon, or maybe some part of this may have already been paid by the company. So whenever you pay this, what do? You will release a part of it. Okay. Or at times, company may have also paid a part of it in the form of an advance tax. So in that case, let's suppose an advance tax amounting to rupees 90 has been paid. Okay. So now in the balance sheet, when you will present it, what will you do? You will present net. You will say my liability is 100, asset is 90. So what do you present? 10. Yeah. So this is how you do. I think this was your query, is it? Yeah. All right. Anyone else? Any more questions on this? Then I'll just move back to the presentation. Okay. So we talked about timing differences. Now let's also touch upon the permanent differences. Now, what are the permanent differences? Permanent differences, once again, are the same set of differences which arise between the accounting income and the taxable income. But these are those differences which do not reverse in the future years. Means these differences will remain forever. They will never reverse. They will never reverse. Can you give me some examples of permanent differences? Over to you. Can you give me some examples of permanent differences? Over to you. Yes. Some examples of permanent differences means the differences which will not get reversed in the future years, which are going to stay permanent. Quickly, over to you. Yes, tell me examples of permanent differences. Srinivasan is saying interest income. Okay. Nidhi is saying some expenses which are disallowed. Very good. Some expenses which are disallowed and which will never be allowed. Okay, means disallowed forever. So what will happen? In the books, you will record that as an expense, but income tax will never allow that. Okay. Pooja is saying additional depreciation. Once again, yes. Yeah, because this is again going to be a permanent difference. This will never get reversed. Okay, then I think Baswant is saying gratuity provision. Gratuity provision, not really, because gratuity is something which will be allowed. So in the books, you will create an expense for this. In income tax, this will be allowed on payment basis. Okay, so that's why it will be a timing difference, not a permanent difference. Okay, then I think some more examples which I've received. Sento is saying interest on tax exempt securities. I would say a very common example for this could be donation. Donation. Yeah, Baswant is then saying leave encashment. See, leave encashment again is the same thing. That will be allowed on payment basis. So in the current year, this may be disallowed, but in the future years, this will be allowed whenever it gets paid. Because that's why it will be a timing difference, not really a permanent difference. Understood? Yeah. Okay, so now in terms of the methodology, what did we discuss? So how do you compute deferred tax? Very simple. You will pick up the statement of P&L and you will also pick up the tax return. You will compute accounting income, accounting and taxable income, differences between these two, if they are timing differences. So on those timing differences, you will apply the tax rate. You will apply the tax rate. And therefore, the final amount that you will get will be deferred tax. And that deferred tax could be an asset or a liability. So that is something you'll have to assess the way we have discussed. Okay. Then I think Pooja has also responded to this. Great. All right. So now let's talk about the tax rates. Now, what are the tax rates that you'll use for the purposes of creation of deferred tax? See, income tax is something we already know. So now, what is the tax rate the company will use for the purposes of creation of deferred tax? So the standard says tax rates which have been enacted or substantively enacted by the balance sheet date. Yeah. So what do you mean by this? Means if you look at the current year. Okay. So if we talk about 23-24. Yeah. So for 23-24, when you will record a deferred tax, whether it's an asset or a liability, tax rate will remain same for both. For these two, what do you consider? You will have to consider the tax rate of 24-25. Means next year's tax rate you'll consider. Why? Because by the balance sheet date. So what is the balance sheet date? 31st March 2024. See, the way it works in our economy is that by March end, we understand the tax rates which have been enacted or substantively enacted. And what rate does it happen to be? It happens to be the rate for the next year. Okay, clear on this? Now, I think this is a small example. We have already discussed this. All right, so now I have a query from Srinivasan. He is asking, sir, when is deferred tax asset and when is deferred tax liability current and non-current and its impact? See, deferred tax asset and liability, or you can say deferred tax as a whole, you don't call them as current or non-current. You will never call them as current or non-current. Okay. they will always be presented under non-current items in the balance sheet. Well, okay, but as such, you'll not call it as whether they are current or non-current, but they are always presented under non-current. Yeah. All right. So now moving on to the next part. So at times, a company could be running into losses for past so many years. So say a company is there for last so many years. So this is year 1, year 2, year 3, year 4. So now what do you find? In all of these years, company has been making losses, incurring losses. And these losses are getting accumulated. Yes or no? And there's a time frame which is allowed under income tax up to which you can just, carry forward those losses. Whether it is in the form of depreciation, whether it's in the form of business losses. So there's a time frame up to which you can carry forward all of those losses. Now, in respect of those losses, if you analyze it from the perspective of timing difference, it will be considered to be a timing difference. Let's think about it. Why it will be a timing difference? Say there is a tax loss amounting to rupees 100 in these 4 years. Okay, let's suppose there is a tax loss of rupees 100 which has got accumulated to rupees 100 in the 4 years period. Now, in the future years, let's suppose starting from year 5, if the company starts making profit, then all of these tax losses will be allowed to be adjusted against those profits in the future years, and thereby company will not be required to pay tax in the future years. So therefore, this tax loss in a way is what? This is again a timing difference. Because what was the definition of timing difference? Something which originate in 1 year, but which get reversed in the future period. So tax loss is a similar item. Yeah, so this is also a timing difference in a way. Now the question arises that should we recognize deferred tax on the timing differences which are originating from the tax losses? Okay, so that's the question that we have. Okay, and before I really get on to that answer, if you would just help me assess this tax loss. Let's suppose if we are calling this tax loss as a timing difference, what do you think this is going to create? Deferred tax asset or a liability? I'm not talking about its recognition, whether you recognize it or not. I'm saying principally, if we go by the criteria or the concept that we have discussed, what do you think this will result into? Will this result into a deferred tax asset or a deferred tax liability, or it could be either way? Yes, over to you. Quickly, please answer this. Okay, tell me, what do you think this will become? Deferred tax asset or a liability? Pratima is saying it will result into a liability. What about others? Okay, Rashmi is saying it will become DTA. What about others? Okay, Sento is saying it will become DTA. Okay, what about others? Yes, fast. Everyone, you need to answer this. Okay, Pooja is saying it will become DTA. Okay, what about others? And can you tell me as to why it will become DTA or DTL, whatever is your response? Can you tell me the reason as to why it will result into a DTA or a DTL? I think we have discussed this. So you should be able to answer this fast. Yes, quickly. Why do you think it will become a DTA or a DTL? Over to you. Why do you think? Okay, Rashmi is saying due to loss, tax was not paid in the current year or in the previous years. Okay, and in the future years, when this loss will get adjusted, tax liability will go down. Tax liability will go down. Yes or no? Yeah. So if in the future years, tax liability will go down, what do you call it as? DTA? Yeah. I think same is the response from Unikrishna also, he is also saying because there will be a set off in future. So the company will save on the tax outgo. Yeah. Now the question arises that if this DTA is required to be recognized, what is the principle? Now standard seems to be a bit stringent on this requirement. Standard says that you can recognize a deferred tax asset. Yeah. And if you recognize deferred tax assets, so let's think of a company which has been incurring losses year on year. And on the losses, they are creating an asset. And if you create an asset, so in a way, you are also recognizing an income. Remember that accounting entry, whenever deferred tax asset is recognized, an income gets generated. Yeah. So now standard is saying that this DTA on tax losses can be recognized by the company only if it meets this stringent requirement. What is that? That there is a virtual certainty supported with convincing evidence. Virtual certainty around what? That the company will make profits in the future years. Supported by convincing evidence. What do you mean? That it should not only be a discussion, or it should not only be a management plan wherein they can just come and say, okay, yes, from next year onwards, we'll make the profits. No, management should be able to demonstrate that. Management should have some backup documents in terms of the contracts they have signed, in terms of the projections they would have prepared, the costing plans which they will have, to which they will be able to demonstrate the future profits. Only and only when there is a virtual certainty around this, then the DTA can be recognized. Otherwise, a DTA cannot be recognized. Okay, clear on this? Okay, so I think Ritika has a query. Yes, Ritika, please go ahead with your query. Yes, Ritika, you can unmute yourself and ask question. What is your query? Yes, Ritika, do you have a query?
सर आई हैव अ क्वेरी दैट अगर हमें कोई भी एक्सपेंसेस फ्यूचर में अलावेबल होता है तो वो असेट है, और अगर कोई भी एक्सपेंसेस फ्यूचर में डिसअलावेबल होता है, या फिर जैसे हमारा डेप्रिसिएशन आज ज्यादा चार्ज हो रहा है और फ्यूचर में कम चार्ज होगा, मतलब होगा ही नहीं, तो वो एक्सपेंसेस है.
यस, सो मैं ये बोलूंगा कि द वे यू शुड लुक एट इट should be in the form of whether it will result into a tax outflow or not in the future years. So that is how you should look at it. For example, I'll come back to that depreciation. Or let me just take one more example. Say in the current year, company has created a provision for gratuity amounting to rupees 100. Or let me just go to that working file. Say in the current year, company has created a provision of rupees 100. Okay, in the books, there is a provision of rupees 100. So means there is an expense of rupees 100. But income tax disallowed this. Income tax is saying we don't accept this. Why? Because it's only a provision. You have not paid this amount. So that's why they are saying for us, this amount is zero. So that's why what is going to happen? In the current year, we will pay tax on this 100. But in the future years, whenever the company will pay this expense, yeah, whenever the company will pay this expense, so what will happen? Income tax will allow this. So income tax will say, now I'll allow this amount. So whenever they will allow, what will happen? For that particular year in the future, my tax outflow, my tax outgo will be reduced. My tax outgo will be reduced. And that's why in the first year, you can say somewhere over here, I will have to consider this as deferred tax asset. Why? Because this is going to save my tax outflow in future years. Okay. So I would say every time if you want to apply the concept, what is it that you should consider? You should consider whether there will be a tax outflow in the future years. If you say yes, my tax outflow will increase in the future years, then what will you call it as? You will call it as DTL. And if you say no, my tax outflow will be reduced or there will be no tax outflow, then what will you call it as? DTA. Understood?
Yes, sir.
Okay, great. Any more questions? Anyone else? All right, so I'll just go back to the presentation. Okay, so now in terms of this presentation of DTA, DTL, I think we discussed. Just a minute. So I'll just pick up one example and that we can discuss. Okay.
हेलो हेलो सर, गुड मॉर्निंग
Yes, please go ahead.
सर। मेरे को वो परमानेंट डिफरेंस में कंफ्यूजन, उसका कोई एग्जांपल बता दें तो।
Can you please repeat your question? किसमें कंफ्यूजन है?
सर टाइमिंग डिफरेंस है वो तो समझ आ रहा है, फिर परमानेंट डिफरेंस है वो, उसका क्वेश्चन कैसा आएगा या वो क्या होता है, समझ में नहीं आ रहा।
ओके, सो यू आर सेइंग परमानेंट डिफरेंस क्या होता है वो समझ नहीं आया? हाँ, ओके, so let's take an example again. So again, let's take an example for this permanent difference. For this permanent difference, let's suppose there is an expense. Say there is an expense of donation. Now donation, if the company would have paid, okay, this would have been considered as an expense in the books of accounts. Let's suppose this is 100. This is 100, okay? But will the income tax allow this entire amount of donation? The answer is no. In the current year, income tax has got some rules basis which they will consider the amount of donation to be allowed. Let's suppose, only hypothetically, let's suppose they consider only 50. Okay, so 50 is the amount which they have allowed. Remaining 50 they have disallowed. Okay, so 50 is disallowed in the current year. Okay, so now on this 50 which has been disallowed in the current year, will the company be paying tax on this 50? Yes. Now the question arises, as around this 50 which has been disallowed in the current year, that will this be allowed at any point of time in the future years? Okay, so in the future years, this is my current year. In the future years, will this ever be allowed? Now, if you look at the provisions of the income tax, this will never be allowed. So that's why, what does it become? This will become a permanent difference. Understood? Permanent difference means which will originate in a particular period, but which will never reverse. Which will never reverse in the future years. And that's why you call it as permanent difference. Understood?
Yes.
Clear है आपको?
It means if permanent difference, then अगर no liability or no मतलब ऐसे,
yes,
because of loss होगा तो loss होगा या profit होगा तो profit.
yes. So permanent difference के केस में this concept that I discussed with you, okay, tax outflow का ये arise नहीं होगा. Okay, so
sir.
will not be able to answer this yes or no in future. Why? Because this situation is never going to arise in future years. That is why you are calling it as a permanent difference, means this difference has got created forever. This will never reverse. Okay, clear on this? Then I think
Yes,
this
sir.
query comes
Clear.
from Baswant. He's asking Sir, whether we have to consider this permanent nature items in DTA or DTL working, if in the question you have some information in relation to some items which will impact which will result into DTA or DTL, and some of the items are permanent in nature. So when you will solve that question, so definitely while computing deferred tax, you will only consider timing differences. But those items which will be resulting into permanent differences, you'll have to comment on that. Okay, so you'll have to specify that this item has not been considered. Why? Because it's a permanent difference. If let's suppose there are 2 items, 3 items, only 1 item, so you'll have to comment on that. So you can just simply not ignore that. Okay, so you'll have to answer that. That will not form part of your working, that will not form part of your solution, but you will have to attempt that. Okay, clear on this? Okay, so then I think I have an example. We can solve one question. Okay, so let me just get on to that example. So we'll solve one question on this because we are done with this topic, and I would advise everyone to solve along with me. And once we are through with this, then we'll move on to our next topic. Okay, then I think Ritika in the meantime has shared some examples. Very good. Okay. Okay, quickly, yeah. So please start reading this question and start solving this on your own. I'll also be solving this, but I would suggest that you should solve this and you should also answer this once you are done. So following particulars are stated in the balance sheet of Siddhi Limited as on 31st March 2022. So DTL and DTA. Okay, so these are the 2 line items appearing in the balance sheet. The numbers are rupees in lakhs. Okay, numbers are rupees in lakhs. Now, during the year 22-23, okay, so during the financial year 22-23, some transactions have taken place. So for which information is available. So depreciation as per books, depreciation as per income tax, this is given. Then interest paid to NBFC accounted in books on accrual basis, but this was paid on 30th June 2023. Okay. Items disallowed for tax purposes in 2021-22, but this got now allowed in 22-23. So please remember, we are talking about 22-23. So this is our reporting here. Okay. Donation to a private trust, 40. Tax rate is also given to us, 15%. So we will not be required to do that. And there were no additions to property, plant, and equipment during the year. You are required to calculate deferred tax asset and deferred tax liability as at 31st March 2020 as per the requirements of AS 22. So you can just start solving this on your own. I am also getting onto the solution, but I would suggest that please don't follow me. Solve this on your own and start sharing your final answer. Okay. Yeah. So now when we begin with, so we have got various items on which we'll have to analyze the impact of deferred tax. What are those items? These are the items. Okay. So one is depreciation, second is interest, third is disallowance, fourth is donation. So on 4 items we'll have to consider the deferred tax impact. Okay, so let's go on this one by one. Now in terms of this first item on depreciation, can we say it's a timing difference? The answer is yes, it's a timing difference. Okay, so now what is going to be the timing difference? 15 lakhs less 20 lakhs. So 5 lakhs will be the timing difference. 5 lakhs will be the timing difference on which we'll apply the tax rate, and we'll get 0.75. Now the question arises that whether this will result into a DTA or a DTL. So that's the most important part. Now let's try to understand this. See, as per the books, depreciation is what? 15 lakhs. As per books, depreciation is 15 lakhs. And as per tax, depreciation is 20 lakhs. So that means income tax has allowed more depreciation in the current year. If more depreciation is allowed in the current year, in the future years, lesser depreciation will be allowed. Therefore, in the future years, my tax outflow will increase. Yes or no? My tax outflow will increase. So therefore, what will it result into? DTL. This will result into DTL. Okay. Now, second item, as around interest, is there anything specified that as per income tax, whether this will be allowed or disallowed? No. So we'll consider that whatever is the tax expense, sorry, income tax, interest expense, income tax will also allow that. Okay. So that's why, will this result into any difference? No. And should we really call it as a permanent difference? No. Why? Because there's no difference at all. Yeah. So in the books, as well as income tax, there is no difference. So that's why it's not a timing difference. Now, in the question, you will have to attempt this. You will have to specify that this is not a timing difference. Okay. Third item. Now, in the third item, what did we have? In the third item, an expense was disallowed in the previous year. But now in the current year, that expense has got allowed. That has got allowed. So if in the current year, this expense has got allowed, what will be the consequence? My tax outflow will go down. My tax outflow will go down. Yes or no? So now, in respect of this item in the previous year, company would have recorded deferred tax asset, considering the fact that my tax outflow is going to go down in the future years. So now that deferred tax asset which the company would have recorded in the previous year, what do we need to do on that? Reverse that. Reverse that. Okay. Yeah. And how do you do that? So the amount is 1.05 lakhs into 15%. Okay. So that is what you get, 15,750. So in terms of lakh, you can just present it this way. Okay. And the last item, on the donation amount. Now on donation, what do we understand? That this will not be allowed by the income tax department. This will not be allowed by them. So what will happen? So this will become a permanent difference. So on permanent difference, do we compute deferred tax? No. No. Okay. So now, in the beginning, what did we have? We had DTL 2.5 lakhs and DTA 1.35 lakhs. 2.5 and 1.35. Now, during the year, a DTL has got recognized amounting to 0.75. So what do? You will take it over here. So therefore, the balance of DTL will become what? 3.25. Okay, this will become 3.25. And on the DTA, there is a reversal of DTA amounting to 15,750. So which you will adjust here. Which you will adjust here. So that's why, what is the balance of DTA that you will have at the year end? 1.192. 1.192. All right. Yeah. So this is how you are required to solve this. So idea was to discuss the concept that we have discussed, also practice one question, and also just to look at as to, how you need to present this in terms of answering the question. All right. So I think Ritika has a query. Yes, Ritika, please go ahead. And in the meantime, I would request everyone to please share your solutions if you have solved this. Yes, Ritika, please go ahead with your query.
सर जैसे कि एक क्वेश्चन, मतलब एक एडजस्टमेंट था जिसमें बताया गया था कि हमने जो डिसअलावेबल था अर्लियर ईयर में और अभी अलावेबल है, तो अगर क्वेश्चन में कुछ नहीं लिखा रहेगा कि पहले डिसअलावेबल था पर कौन से ईयर में अलावेबल है, तो हम लोग उसको कंसीडर करेंगे या नहीं करेंगे?
हम उसको कंसीडर करेंगे। देखिए, क्वेश्चन को इंफॉर्मेशन तो पूरी देनी पड़ेगी एंड क्वेश्चन विल ऑलवेज स्पेसिफाई कि उसका करंट ईयर में ट्रीटमेंट क्या होगा। ओके, क्वेश्चन आपको हमेशा ये चीज एक्सप्लेन करेगा। सो इट विल नेवर हैपन दैट द क्वेश्चन विल रिमेन साइलेंट इन टर्म्स ऑफ इट्स ट्रीटमेंट इन द करंट ईयर। ओके, क्वेश्चन में रिमेन साइलेंट on its treatment in the future years. Why? Because that is something which is required to be assessed by us. but the question will never remain silent on its treatment in the current. So that information will always be available. Yeah. If by chance, if let's suppose you come across a situation wherein you believe that the relevant information is not available. So what do? You will put down an assumption. You will say that this is the assumption basis which I have solved this. Understood? Yeah. But this will always be available. Okay, so then I have this query from Uni Krishnan. Uni Krishnan is asking, sir, interest to financial institution in books is accrual basis? No. So see, interest, whether that is paid or not, is allowed by both. So that is what we have considered. So that is not really a timing difference. So we'll not go by that. Okay, so Srinivasan is asking, sir, can you please explain reversal of DTA? Yes. See, reversal of DTA is what? That in the previous year, an expense got disallowed. Okay. And in the previous year, when that expense got disallowed, company knew this will be allowed in the future years. So in the previous year, what is it that the company would have done? Company would have recognized a deferred tax asset on that. Yes or no? Company would have recognized deferred tax asset on that. Yeah. Now, when you move on to the current year, in the current year, when this amount is actually allowed, so what will you do? That DTA which you have recorded, you will have to reverse that. You'll have to reverse that. So this is what is called as reversal of DTA. Okay. Uni Krishnan has got one more query. He's asking, sir, tax loss is considered for DTA for how many years? See, for tax loss, this again, information will be available to you for how many years you'll have to consider that. If the years are not available, you will consider that to be at least for next year. Okay, at least for next year, it will be available. And accordingly, you'll call it, assess whether it will be a DTA or a DTL. So it will not be required to really get on to the number of years. Okay. Then I think Rashmi has a query. So Rashmi is asking, sir, donation point, can you please repeat? Yes, sure. See, as regards donation will be allowed in the books of accounts. Donation will be allowed in the books of accounts as an expense, but income tax will not allow this. They will not allow. So if they don't allow this, what will happen? It will become a permanent difference. Okay. I think Srinivasan has understood this. Great.
Hello, sir.
Yes.
सर मेरे को इस जो क्वेश्चन था उसमें जो डोनेशन है उसमें डाउट था कि इसमें जो अलाउ नहीं है इसका मतलब परमानेंट है डिफरेंस मींस परमानेंट डिफरेंस का ट्रीटमेंट नहीं होता है
आपसे परमानेंट डिफरेंस का ट्रीटमेंट नहीं होता is that the question you are asking? Yeah. See, permanent difference का ट्रीटमेंट सिर्फ यही है, you will have to specify it's a permanent difference and it will not form part of your working of deferred tax. That's it. Okay. Yeah.
Okay, sir.
All right. So with this,
good morning, sir.
Right. Yes.
सर मुझे ये जानना था कि जिस डेफर्ड टैक्स एसेट और मतलब डेफर्ड टैक्स लायबिलिटी को क्या हम म्यूचुअली एडजस्ट कर सकते हैं ना, जब एक ही हो या दोनों ही होंगे सर? तो ये थोड़ा कंफ्यूजन।
पूजा, कैन यू प्लीज रिपीट? योर वॉइस इज नॉट वेरी क्लियर।
सर मैं ये जानना चाह रही हूँ कि जैसे डेफर्ड टैक्स एसेट्स होता है और लायबिलिटी होता है, क्या हम इन्हें आपस में एडजस्ट कर सकते हैं? मतलब
यस
या दोनों शो होंगे सर?
नहीं, सो दोनों शो नहीं होंगे। See, you'll go by the question. In the question, if they are presenting both, so you'll also present them both. But deferred tax asset and liability, you will always present on a net basis. Okay. And how will you do that? So let's suppose your DTA is 100, DTL is 200. So what do you present net? DTL. If let's suppose your DTA is 500 and DTL is 200, what do you present net? DTA 300. So you'll always present that net. But in the question, because they are presenting both gross, so that's why while answering this, we have also presented that gross.
बैलेंस शीट में हमें नेट ही दिखाना होता है.
Balance sheet में yes, you will present that net. So again, there is a criteria for doing that. So the standard says if it meets the set of criteria. Now, what is the set of criteria? Set of criteria means you will check whether these are legally adjustable or not. So legally, if you can set it off, then you will present it net. Okay. And if you are looking at one company, means if we are talking about standalone financial statements, so that belongs to one jurisdiction. So all of these line items which will arise in respect of a DTA or a DTL, so they will belong to one jurisdiction and that will get adjusted against each other in most of the cases. And that's why you will say it meets the criteria of set off, and that's why you will present it net. Okay. Yeah. Any more questions? Anyone? Any doubts on this? Then I think Nidhi has some queries on the practical questions. So Nidhi, if you could just specify the query, I think it will be helpful. Otherwise, maybe towards the end, we can just try to pick it up. Okay. Preeti is asking, sir, what is accumulated? I have not understood your query completely. What do you mean by accumulated? Maybe if you can just, elaborate on this. What do you mean by accumulated? Anyone else? Any more questions on this? Then we'll move on to our next topic. All right, so let's move on to our next topic. So we'll start with the topics around revenue. And in terms of revenue, there are a couple of standards which deal with the revenue recognition. One is AS7 and the other one is AS9. So we'll begin with AS7, which deals with the revenue recognition requirement in relation to the contractors. Okay. All right. So now we are talking about revenue recognition here. Revenue recognition means the recognition of sales. So in the P&L, the most important item for any entity happens to be what? Sales. Yeah. So in the P&L, that's the most important item that you find. So now we are talking about that sales, how the company will recognize that sales. Okay. Now, for this revenue recognition, currently, as per the requirements of this accounting standard, means AS7, we are limited to only the contractors in respect of their construction contracts. Means this standard deals with the revenue recognition only for construction contracts only. Now you may be thinking, what about others? Yeah. So for others, we can definitely discuss that, but that is something which comes from the requirements of AS9 and not really from AS7. Okay. Now, I think in the meantime, I have this query coming from Srinivasan. So I think we have sort of completed one standard, and before I really get into the details of this another standard, if you would just please quickly confirm, do you want a break now? Should we really take a break now, or shall I continue? Because we have got more topics to be covered. Yeah, so AS7 and AS9, we plan to cover both. And again, we'll have to see as to how the flow really goes. So please quickly confirm, are you looking for a break or should we really continue? Yes, everyone. Pooja saying no break. Kiran is saying no break. Srinivasan is saying, sir, 5 minutes. Pratima is saying no break. Yeah, so no break. Yeah, so I think we can continue. And I also, okay, so Bhumika is saying 5 minutes. Okay, some of you are saying take a break. Some of you are saying don't take a break. Yeah. Okay, so Unni Krishnan, Sangeetvani, they are saying, sir, continue. Baswant. So I think majority of you are saying continue. So I would suggest let's continue on this. Yeah. All right. So now as around the construction contract. Let's try to understand as to what does it mean. Because in respect of this construction contract, we now need to understand what is going to be the revenue recognition criteria. So first, what is a construction contract? Construction contract is a contract which is specifically negotiated for construction of an asset or a combination of assets, okay, that are closely interrelated or interdependent in terms of their design, technology, function, ultimate purpose. Okay. Now, what could be the examples? Before we get on to the examples, for a construction contract, generally there is a feature that these are those contracts which take longer period of time to get completed, and which is generally 1 year or more. Now, if you look at those examples, what will be the example? Construction of bridge, construction of building, dams, pipelines, road, ship, tunnel. So all of these contracts in terms of their construction, what do you call it as? Construction contract. Means which will take substantial period of time to get completed. And what is that substantial period of time? 1 year or more. So that is how you are required to look at it. Okay. And only if it is a construction contract, it will fall within the purview of AS7. If it is not a construction contract which meets this criteria that we have discussed now, will it fall within the purview of AS7? The answer is no. Okay. Yeah. Answer is no. Now, we understand that these construction contracts could again be of two types. So we discussed about construction contract. Now, these construction contracts could again be of two types. Okay, I can see this query coming from Preeti. Preeti, I'll come to your query. Yeah? Okay. Now, what are those two types? One is a fixed price contract, or you can say fixed price construction contract, and the other one is cost plus construction contract. So let's try to understand about both of them. What do you mean by a fixed price contract? So let's suppose a contract is awarded for construction of road, and the amount of revenue in that contract is fixed. Let's suppose this is rupees 2 crore. So 2 crore is the fixed amount. Okay, whatever be the amount of the expenditure which the contractor will incur, 2 crore is the fixed amount which will be paid to him. So what do you call it as? This is called as fixed price contract, wherein either the amount is fixed or the rate per unit of output is fixed. As against that, at times, the arrangement could be different between two parties, contractor and the customer. Let's suppose the contractor says that I'll bill you as a percentage of the cost that I incur. So let's suppose if I incur a cost of 1 crore, then I'll add a markup of 10% and I'll charge you 1.1 crore. Okay. So in this case, what is agreed between both the parties, the contractor and the customer? The markup, margins. Why? Because this cost will remain variable. If let's suppose this 1 crore becomes 2 crore, then the amount of revenue will change. Okay. So in this case, generally a percentage of margin is something which gets fixed. So that's why this is called as cost plus contract. Means the billing will be done on the basis of cost incurred plus the margin. And at times a contract may have both these features. It may have some component which is moving into fixed price and some component which is moving into cost plus. Okay, so either of these types are possible. Now, let's talk about this contract revenue. Now, what could this contract revenue really comprise of? So one component as around the contract revenue will be the initial amount of revenue, okay, which is going to be the fixed amount. So first component is initial amount of revenue, which is agreed. Okay, fixed amount which is agreed. So say 2 crore, it is fixed, agreed. Another component of the contract revenue could arise due to variations. See, if you look at the way this project works, the way these contracts work, because there is a time horizon, which is for a longer period of time and which goes on for number of years, okay, for a long period of time. So that's why at times contractor may feel that his cost incurred is higher. Okay, he estimated say X amount, but he has been actually incurring X plus 1 amount. Okay, so his cost has gone up. So that's why what he may do is he may ask for some variations, escalations from the customer. At times, what may happen is initially when the contract was started, so the scope of work was agreed, but after that some changes have been made in the scope of work, due to which the cost of the contractor will increase and he will ask for those variations. And at times there would also be some incentive payments, which two parties may agree. So the customer may say that if you complete this contract within 2 years, as against 3 years, then I'll pay you 10% extra amount. What do you call it as? Incentive payment. Those are called as incentive payments. Now, when it comes to the fixed or the agreed amount, which has been initially agreed, so this will always form part of contract revenue. But when it comes to some of these components like variation, claims, incentives, so these components will be recognized as revenue only when it is probable. Probable means there are chances that this money will be received. Okay. Only when they are considered realizable, then they will be considered as revenue, otherwise not. Okay. So one will have to assess whether this money will be received or not. Okay. So that's why we can say that following could be the examples of various components in the contract revenue which may arise. There may be some cost escalation also. Maybe the contractor is incurring significantly higher cost and the contract is getting dragged. Let's suppose initially it was agreed for 3 years. Now the contract is dragged for 5 years. So for 2 more years. Now inflation is also there. Costs are going up. So that's why contractor is requesting for some escalation. Okay, so there are different types of components which may arise in respect of contract revenue. Okay, now let's talk about the contract costs. Now contract costs could again be segregated into various types, but I would just simply say there are two broad categories we need to consider. One category of cost is that cost which will form part of the contract cost. Okay, so this is the category which will form part of the contract cost. And the other category is what? Which will not form part, means which will be excluded from the cost of the contract. Now, please remember that for the purposes of revenue recognition and for the purposes of accounting requirement as per AS7, both these concepts, contract revenue and contract cost, are very important. Okay, so that's why if you have any questions, any doubts, please ask me. Okay, so now let's talk about both these costs. In terms of contract costs, any cost which is incurred in relation to the project, any cost which is incurred in relation to construction of the project, construction of that contract, or construction of that particular item, that cost will form part of the contract. But if there is any cost which is incurred which has got nothing to do with the construction, say for example, that is for marketing, that is for selling, that is for advertisement, so will that form part of the construction cost? The answer is no. Answer is no. So any cost which has got nothing to do with the construction, that will be excluded. Now, what could be the example for that? Selling cost. Okay, research and development, administration cost. If this cost has got nothing to do with the construction. But let's move on to those costs which will form part of the construction cost. So in this case, every time, what is it that you need to remember? That any cost which is incurred in relation to the construction. For example, site labor, material cost. So let's suppose plant and machinery is used for the construction purposes. Okay, so rental of that plant and machinery. If that plant and machinery is getting depreciated, if that is owned, depreciation of that plant and machinery. Okay, if let's suppose a consultant has been engaged who will advise as around that construction, so cost of that consultant. If let's suppose some borrowing costs have been incurred and that borrowing cost is taken specifically for that construction, that will also form part of that cost. Okay. If let's suppose insurance has been taken in respect of that project, in respect of that asset which is getting constructed, so insurance cost. If let's suppose there is any other cost could be in relation to the miscellaneous costs, okay, which are specifically contributing to the construction of that particular asset. So all such type of costs will form part of the construction contract or construction contract costs. Okay, so I would suggest that you need to just simply go by the two principles. One, costs that will be included and costs that will be excluded. Okay, so Unni Krishnan has a query now. He is asking, sir, can I adopt partly with disclosure in books? I couldn't understand. What do you mean by can I adopt partly with disclosure in books? Maybe you could just elaborate, clarify. What is your query? Couldn't understand your query. Okay, so now I'll move further. So now recognition of contract revenue and the costs. Standard says that for the purposes of revenue recognition, when the outcome can be estimated reliably, then the revenue will be recognized. And which methodology you will apply in respect of revenue recognition? Percentage completion method. Percentage completion method you will apply. Means every year company will check. Let's suppose contract is for 3 years. So every year company will check what is the percentage of work which has been completed. Let's suppose if it is 30%. So 30% revenue will be recognized. Let's suppose in second year it is 50%. So 50% revenue will be recognized. So this is what you call as percentage completion method. Okay. Now, in respect of this percentage completion method, there are certain methods which have been prescribed. Because now you may have a question that, sir, this is understood that percentage method will consider on the basis of percentage completion will recognize the revenue. But how do you derive the percentage completion? So what will become the basis for derivation of percentage completion? Okay, so how do you come to that? How do you reach that number? So for this, again, some methods have been prescribed by the standard itself. Standard says there are some methods which the company can use for the purposes of calculation of percentage completion, which is also called as stage of completion. Percentage completion. So what are the methods? One is by physical evaluation. Means the technical valuer will evaluate that. Maybe he'll just go to the site. So let's suppose building is getting constructed. So he'll evaluate that physically. He'll physically check and he'll tell whether it's 30% or it's 45%. Okay. Second is survey method. So a survey will be conducted, and basis that again percentage will be specified, whether it's 50% or 35%, whatever is the percentage. Third is called as cost method. I would say the most important and the widely used method. Cost method. Cost method. Practically, this is the method which is used by the companies for the purposes of calculating percentage completion. So let's understand as to how does this methodology works. It says that company would initially estimate that for the entire contract, what is going to be the estimated cost. So let's suppose it's a 4 years contract. It's a 4 years contract. So company will estimate what is going to be the cost for this entire contract. Yeah. So let's suppose company says estimated cost is 100 crore. Okay. So estimated cost is 100 crore. Over a period of 4 years, company will spend 100 crore and the project will be completed. Now, in the first year, if you apply cost method, what is it that you need to check? That in the first year, what is the actual cost which the company has incurred? What is the actual cost which the company has incurred? So let's suppose in the first year, actual cost incurred by the company, let's suppose happens to be 35 crore. So now, as per this method, what will be the percentage completion? As per this method, what will be the percentage completion? Actual cost divided by estimated cost. Actual cost divided by estimated cost. So therefore, what is going to be the percentage completion in this case? Can you tell me? Over to you. What is going to be the percentage completion in this case? Over to you. Tell me quickly. What will be the percentage completion in this case? Fast. I'm not asking you about revenue recognition. I'm just asking you about the percentage completion. So what is the percentage completion that you'll have in first year? Pooja is saying 35%. Very good. Yes. So actual cost divided by estimated cost. Actual cost divided by estimated cost. So this becomes 35%. Okay. Yeah. I think same is the response from Unikrishnan, Shivanna, Baswant. Very good. Now, in the first year, we have understood how percentage completion will be worked. Okay, we have understood how the percentage completion will be worked out. Now, let's also try to understand how the revenue will be recognized in the first year. Okay. Now, if let's suppose in this example, contract revenue for entire 4 years period happens to be contract revenue happens to be 150 crore. Let's suppose contract revenue is 150 crore. So now, can you tell me what is the amount of revenue which the company will recognize in the first year? Can you tell me what is the amount of revenue which the company will recognize in year one? Over to you, quickly. Over to you. Okay, Pooja is saying 150 into 35%. Very good. So Ritika is saying 47.25. Yes. What about others? Quickly solve this and let me know. So what is going to be the amount of revenue which the company will recognize in the first year? So it will be 150 crore into percentage of work completed. So what is the percentage of work completed? 35%. So therefore, what is this amount which the company will recognize as revenue in the first year? 52.5. Yeah, so Ritika, you may revisit your number as to how did you get this 47.25. I think same is the response which I got from Baswant as well. Very good. Okay, everyone clear on this so far? Any doubts, any questions? If you have, please let me know. I can see some queries from Unnikrishnan. Unnikrishnan is saying, sir, AS7 is not adopting as recommended, partly adopting the standard. No. See, accounting standards are mandatory. Huh? So there is no option to adopt or not adopt them. So if they will apply, company will have to follow them. Then Srinivasan is asking about the notes. Yes, of course. See, all of these discussions that we have been doing, I have suggested that you should create your own notes. But all of these discussions in terms of the presentations that we have been doing, so these will be available. These will be available to you. Okay, then Shivanna is asking, sir, 35% on 150 crore. But what if the property is not yet booked by the customer? Does it matter? Doesn't matter. So we'll just simply go by the percentage completion method. Okay. Yeah. So we'll not get into all of those technicalities. So that should not bother you as far as AS7 is concerned. Okay. Then I think Preeti has a query. Preeti is asking, sir, fixed contract cost may be increased due to increase in money value. Yes, that is what you call as escalation. And that is why the contractor may reach out to the customer when generally the project gets delayed for that money value. In fact, the time value, that is what you call as escalation also. Or it could be because of the changes in the scope of work. So there are various reasons which may lead to this. Yeah. Then I think Preeti also asked me about accumulated profit. So accumulated profit, I think you are discussing in the context of deferred tax. Yeah. So I'll come to that query once we are through with this topic. Otherwise, we'll just digress from this topic. I'll come back to your query. Okay, anyone else? Any more queries on this? I think Venkatesh also solved this. Preeti also solved this. Pooja solved this. Very good. All right. So now, there's one more concept as around this AS7. So let's discuss that concept once. And then we'll pick up some examples also basis that. See, the standard says, if by chance you have any such situation, what is the situation? Say there is a contract for 4 years. So it's a 4 years contract. Year 3, year 2, year 1, and this is year 0, means at the beginning. Now, when the project will be awarded, so there will be a contract revenue which will be agreed for this. So let's suppose contract revenue which has been agreed is 100 crore. Is 100 crore. Okay. So the contract revenue which has been agreed is 100 crore. And over here, the estimated cost of the contract, if by chance happens to be 105 crore. Now, is this possible? Yes, this is possible. At times it may happen. At times it may happen that the company wants to maybe get into the business, pick up some business. Okay. They want to get into a new market for which they may pick up a project, even if that project is loss making. So if you look at this project, if you look at this contract, one would say that this is a loss making project. Why? Because revenue is going to be 100 crore and the overall cost of the project will be 105 crore. So net company will end up incurring a loss of 5 crore. Yes or no? Tell me. Yeah. So it's going to be a loss making contract. Correct? It's going to be a loss making contract. Now, as around this contract. What we also understand is that this contract cost will not be recognized in the first year itself. This cost will be incurred over a period of 4 years. Yeah. And similarly, if you look at this revenue of 100 crore, so this will again not be recognized in the first year itself. This will be recognized over a period of 4 years. Okay. So we have contract revenue as well as contract costs getting recognized over a period of 4 years. So in a way, even though when we start the project, we understand this will result into a loss, but because this revenue is going to get recognized over the period of the contract, this cost will be spread out over the period of the contract. So that's why technically, if you look at it, what is going to happen? This loss will also spread out over a period of 4 years. Yes or no? Tell me, everyone. Yes or no? So in a way, this loss will also get spread out. This will also get recognized over a period of 4 years. Yeah. So technically, this is how this will work. Yeah. Yes. Quickly, please confirm. Yeah. So this will get recognized over a period of 4 years. Now, if you are into any such situation wherein at any point of time, it gets known that the contract will result into a loss. So the standard says you should recognize that loss upfront immediately. Why? Because it's a loss which the company has incurred, but which is waiting to be recognized. Okay, so you should be prudent in terms of the accounting requirement basis which any such loss should not wait to get recognized in the books of accounts. That should be recognized immediately. Clear on this? So in this case, whenever the company will get into this situation, so let's suppose, say we are somewhere over here. We are somewhere over here. Okay, and we find that the company is into this situation. So now on year 0, what is it that the company will do? In first year itself, company will recognize this loss of 5 crore. So we are not saying entire revenue, entire cost will be recognized. No, only this loss of 5 crore will be recognized immediately. Remaining components will continue to get recognized as it is. Okay. Yeah. I think Harish is also answering the same thing. So this is what you call as making a provision for foreseeable losses. Okay. So now we'll pick up examples. Okay, so let's look at this example. B Limited undertook a construction contract for 50 crore in April 2023. The cost construction was initially estimated at 35 crore. The contract is to be completed in 3 years. While executing the contract, the company estimated the cost of completion of the contract at rupees 53 crore. Can the company provide for expected loss in the books of accounts for the year ended 31st March 2024? Over to you. What do you think? Quickly, huh? Over to you. What do you think? What should be done in this scenario? Yes, tell me. What should be done by the company in this scenario? Yes, waiting for a response. Sangeetvani is asking, sir, why should the company enter into such contract wherein the company will understand that there's a loss? See, it may happen. There are business purposes for this. So let's suppose it's a new business which has come up. Company is starting a new business line. So initially, company may have to pick up customers. Company may have to pick up the contracts, which don't come easily. So at times, company may incur some losses. So that is, you can say, considered to be a strategic decision. And these do happen practically. Okay. So now Pratima is saying loss of 3 crore should be recognized in this case. What about others? Quickly, huh? Pooja is saying 3 crore. What do you mean by 3 crore? Ritika is saying yes, because as per AS1, disclosure of future would be done. See, this is not something which comes from the requirements of AS1. This is something which comes from the requirements of AS7. Ritika, please make a note of this, huh? Shivanna is saying 3 crore loss will be recognized. I think Rashmi and Pooja have got the same answers. So now in this case, what do you have? You have the construction revenue of 50 crore and the total estimated cost of 53 crore. So that's why, what do you find? There is a foreseeable loss of 3 crore. So should you wait for 3 years to get this recognized? No, you will have to recognize this immediately. So this should be recorded as an expense immediately. Okay. Clear on this? Okay, then I think Srinivasan has a query. He's asking, sir, if the work certified is 75%, then the 100%, yes. See, percentage completion of work will not matter here. Why? Because we are looking at a stage wherein we are assessing the overall contract. We are not going by percentage completion. We are not saying that in first year, this is the loss, second year, this is the loss, third year, this is the loss. We are saying collectively for this contract as a whole, is there a loss or not? If that is there, you need to recognize. Okay, so that's the second stage which you need to get into. As of now, we are not moving into that stage. We are just analyzing for the contract as a whole. Okay. Then Baswant is asking, sir, expected loss is to be booked in the recognized period only? No, it's not about recognized period. The moment you get to know about the foreseeable loss, immediately you'll recognize. You'll not wait. Preeti is saying, as per the concept of prudence, 3 crore loss should be recognized in this example. Yes, that's correct. Okay. All right. So let's look at this example. So I would suggest this example needs to be solved by you. Yeah. So this captures various requirements in relation to the contract revenue, in relation to the contract cost. Okay. A lot of that stuff is being discussed. So that's why I would suggest that this example you should also solve, and I'll also be solving this. Before that, Unni Krishnan has a query saying, once recognized loss after actual completion, if it becomes probable, or maybe if it's become profitable, then what do you do? No worries. So if that will become profitable, so what will happen? See, that expense which you would have recorded, that will go to P&L. But let's suppose if it turns up into a profit. So over a period of 4 years, if that is a 4-year period, you will recognize income, you will recognize profits. Okay. So that profit has to come over the period. That is acceptable. But loss, if sitting and waiting to be recognized, that is not acceptable. Understood? Understood? Everyone clear on this? Yeah. All right. So let's look at this example. A construction contractor has a fixed price contract for 9,000. Okay. Let's not go by the numbers, rupees 9,000. You can consider this to be, say, rupees in lakhs or rupees in crores. Huh? This only for the purposes of keeping it simple. The initial amount of revenue agreed in the contract is 9,000. So contract revenue initially agreed is what? 9,000. Contractor's initial estimate of the contract cost is 8,000. So in this example, do you think there is a foreseeable loss? Quickly, everyone. Do you think there is a foreseeable loss? Just going by these two, do you find any foreseeable loss in this? Quickly. Pratima is saying no. What about others? Ritika is saying no. Venkatesh is saying no. Do you find any foreseeable loss? No. Why? because the amount of revenue is higher than the contract cost. Okay. So now moving further, by the end of year 1, contractors' estimate of the cost has increased. So now this has gone up from 8,000 to 8,050. So is it possible? Can it happen? Yes. See, estimated cost is an estimate, and the estimate we discussed yesterday also will be reassessed by the management year on year. So at the end of the year, what did they find? That initially the amount they estimated is lower. So that's why they will have to increase the estimate. Contract revenue may be fixed, but cost can always go up. Okay. Then in year 2, customer approves a variation, resulting in increase in contract revenue of 200, and estimated additional contract costs have also arisen, amounting to 8150. So that's why in year 2, what is going to be the amount of revenue? So this will become 9200. And what will be the amount of estimated cost in year 2? Can you tell me? In year 2, can you tell me what is going to be the amount of estimated cost? Estimated cost. Pratima is saying 9200. So that is for revenue. But what about estimated cost? Ritika is saying 1000. Yes. So this was 8050, to which you will add 8150. So this becomes 1000. Okay. Now, at the end of year 2, cost incurred include rupees 100 for standard material stored at the site to be used in year 3 to complete the project. Okay. So now in this case, you are required to do the accounting in respect of this for all 3 years as per AS7. Over to you. You can just start solving this on your own. Over to you. Start solving this on your own and share your answer. So I think some of the information which the question doesn't specify is about the actual cost. In year 1, what is the amount of actual cost? That is not specified here. In year 2, what is the amount of actual cost? That is not specified here. So I think that part of the information is not available. So that's why I'll take you to the solution, because that information has been included directly over there. So let's begin on this. Okay. So let's look at this part first of all. In year 1, what was the amount of revenue? 9000. I'm saying year 1, please, not year 2. And in year 1, what is the amount of actual cost? So you should assume this is given in the question, 2093. 2093 is the actual cost which has been incurred. What was the total estimated cost? At the end of year 1, it was 8050. Okay, 8050 means 5957 is the cost which will be incurred in year 2 and year 3. So in year 1, what do we need to compute? Percentage completion. How do you compute that? How do you compute that? 2093 means the actual cost divided by estimated cost. So what is the percentage completion that you will get? 26%. So this is the percentage completion that you get. Okay. Yeah. Now, let's get on to the P&L. Now in the P&L, let's recognize revenue. Let's recognize expense. Let's record this. So in the P&L, in the revenue, what will be the amount of revenue that you recognize? 9000 is the contract value, multiply with percentage completion. So what do you get? 2340. 2340 is the amount of revenue that you get. Okay. expense, actual amount of cost incurred. I think this is already available, 2093. So this is the actual expense. So what is going to be the profit in the first year? 247. Okay. So this is the P&L that we have for year one. For year one. Okay. Yeah. Srinivasan is asking, sir, one thing is not clear. How did we get 2093? See, this information is provided in the question. That is what you should assume. Okay. So I think it's not written over there. You should think that this is available in the question. That's why I have come to the solution. Okay. Clear? Clear on this? Now, let's move on to year two, this part. Now, year two. In year two, the amount of revenue has gone up. Now it is not 9,000. This has become 9,200. Okay, this has become 9,200. And up to year two, actual cost incurred. Up to year two, actual cost incurred is what? 6068. 6068. Okay. Yeah. So now my estimated cost has also gone up. This has become 8,200. This has become 8,200. Correct? Please remember, these are cumulative numbers. These are cumulative numbers. So when we are talking about 6068 means up to year two, my actual incurred cost is what? 6068. This is not the cost for year two. This is the cost up to year two. Up to. So you can say this is cumulative. Sorry. This is cumulative. Okay. So now what is the percentage completion in year two? Once again, the same methodology. Cost incurred up to year two divided by actual estimated cost. So what will be the percentage of completion? 74%. 74%. Okay. So now let's try to put down the numbers. Now for year two, if we multiply this 74% with the amount of revenue, so what do we get? 9,200 into 74%. So this becomes 6,808. Means up to year two, 6,808 should be the amount of revenue which should be recognized. Fine. Out of this, 2,340 is the amount of revenue which has already been recognized in the previous year. So that means in year two, what is the amount of revenue which will be recognized? 6,808 minus 2,340. 6,808 minus 2,340. Okay. 6,808 minus 2,340. Fine. Now, let's look at the amount of expense. Let's look at the amount of expense. Now, amount of expense for year two, or you can say up to year two, is what? 6,068. 6,068. And if you remember, it was specified in the question that in year two, cost incurred includes rupees 100 for material, which has not been used at the site. So this 6,068 actually is 6,168. This is actually 6,168, out of which 100 is the cost which has not been incurred. That has not been incurred. Why? Because this material is still like at the site. So that's why actual incurred cost has become 6,068. Now, where does this 6,068 come from? This again comes from the question itself. 6068 comes from the question itself. Now, in the previous year, 2093 is the cost which has already been recognized. So what is going to be the cost for this second year? For second year, this will be 3975. And this will be the profit for second year. Clear on this? Yeah? All right. So now moving on to the third year, I think third year will become relatively simpler. Why? Because in the third year, project will be 100% completed. So that's why in the third year, what is going to be the amount of total revenue? 9200. Out of which revenue equivalent to 6808 was recognized up to year 2. Up to year 2. Okay. So that's why in year 3, what is going to be the amount of revenue? 2392. Now, total cumulative expense up to year 3 will be 8200. Out of which cumulative expense up to year 2, which has been recognized as 6068. So that's why in third year, what is the amount of cost that you will recognize? 2132. Okay. Yeah. So this is how the P&L will be presented. This is how revenue will be computed. This is how expenses will be computed. Okay. Any questions on this? Harish is asking about the material cost. He's saying, sir, what about material cost which is included in second year but used in third year? So that I think we have discussed, Harish. Okay, so that has been adjusted. So that will not form part of your cost in the second year. That will form part of the cost in the year when this material will actually be used. Okay, Srinivasan is asking, sir, what would be the revenue, cost and profit if the cost is 8,000 in first year and 8,200 in second year? See, then the numbers will change. So I think you'll have to do this recomputation. So every number will change. So in the first year, what will happen? Your percentage completion will go down. So now it is 26%. It will go down. Okay. And the remaining amount in year 2 and year 3 will also change. That is how it will work. Okay. Everyone clear on this? Any questions, any doubts? If you have on this, please let me know. Yes. So this example, I would say, was quite comprehensive. This discusses various aspects in relation to revenue recognition, in respect of cost, in respects of various adjustments related to cost, escalation, variations. Okay, all of those aspects have been covered. So any doubts, any questions if you have? And I would request Mr. Ajit, if you would just also open this window, maybe the student can ask questions. Anyways, they have been asking questions, but you can just open that for all the students. Yes, quickly, please confirm. Are you clear on this, everyone? Any questions, any doubts on this? Yes, quickly, please. Any questions so far? Any doubts? No? Waiting for a response. Okay, so I think they have confirmed. Sangeetwani is saying, yes, it's clear. Srinivasan is saying, so the only doubt is how did we get 2093? So you should say it's given in the question. So let me just add this. Actual cost, year 1, 2093. Year 2, 6168, including rupees 100 standard material. Okay, this one. Now clear on this? I think this would have been creating a confusion. Okay, yeah. Unnikrishnan has clarified. But anyways, so you can just make a note of this. So this information is available in the question. Okay, clear? Okay, Pooja, Sunil, they are clear on this. Great. All right. So now talking about the disclosures. So some of the disclosures you'll be required to give will be about the revenue you'll recognize, the methodology you'll follow, for the percentage completion that you derive, the contracts which are in progress, the percentage which has not been recognized, okay, somewhat this information. And yeah, so these are some of the disclosures one needs to look at. So with this, we come to an end to our discussion on AS7. Happy to have your questions, any doubts around AS7. Okay, and I think we are also left with one more topic, AS9, which is a continuity sort of in terms of the revenue recognition, which we'll plan to do. So what we can do now is we can discuss your queries, your doubts, and alongside we can also pick up that topic, AS9. Yeah, and during that topic, we can just keep discussing your questions, your doubts. Okay. So before I move to the next topic, any questions that you have so far, you can just ask me. Yes, over to you. Any questions, any doubts? Then we'll move on to the third topic, that is about AS9, revenue recognition. Preeti is saying everything is clear, sir. No doubts. Venkatesh is saying everything is clear. Great. I'm just hoping that you have been able to understand the requirements. Anyways, the concept, I would assume that you have been going through the recordings which are available. But over and above that, it's all about, you know, sort of revising the concept and also practicing that. Yeah, Uni Krishnan is also clear. Okay, great. So we'll move on to the next topic. Yeah, and during the discussion, if you have queries, you can just feel free to ask questions. Okay. So now moving on to next very, very important topic, and that is about revenue recognition. Now, what do you mean by revenue recognition? I would say it's a continuity of what we have done in AS7. And why do I say it's a continuity? See, revenue recognition is what we discussed in case of AS7 also. In fact, as we discussed that for revenue recognition, there are two accounting standards, AS7 and AS9. Now, when it comes to AS7, it dealt with only the construction contracts. And for any other revenue recognition, where do you go? You come to AS9. Okay. Now, under AS9, what could be the form of revenue? Maybe an entity is selling goods. Maybe an entity is rendering services. Okay. Maybe an entity is generating interest income, royalty income, dividend income. All of these aspects are dealt by which standard? AS9. But there are some contracts which have been excluded from AS9. What are those? Construction contract. Why? Because it's been covered by AS7. Lease agreement. Why? Because there is a separate standard dealing with this. Insurance. Why? Because the guidance for that is separate. Government grants. Why? Because there is a separate standard which is dealing with that requirement. Okay. Yeah. Now, let's discuss some example and try to understand as to what is not really covered within the scope of AS9. If there is a realized gain resulting from disposal of PPE. So let's suppose if you sell an item of PPE, can you say it's revenue recognition? Can you say it's a revenue recognition? Over to you quickly. Let's suppose if an organization sells an item of PPE, will that be considered to be revenue for that company falling under AS9? Tell me. Ritika is saying no. Yes, that will not be falling under AS9. Why? Because that will be other income for the company. Okay, so that's why it will be excluded from here. Similarly, if the PPE is revalued, so on PPE, revaluation model is allowed. On PPE, revaluation model is allowed. So if the entity revalues PPE, by which its value goes up, so that is what you call as unrealized gain. Now, will that unrealized gain get treated as per AS9? Once again, no. Why? Because this is not revenue for the company. This is not really a revenue for the company. Okay. Great. Sangeetvani is saying, sir, other point is that this is also not in the ordinary course of business. Yes, very good. Another example, if there is any realized or unrealized gain resulting from changes in foreign exchange rates. If you remember, we discussed this yesterday. If there is any realized or unrealized gain resulting from changes in foreign exchange rates, will you consider that to be a transaction falling under AS 9? Tell me. Over to you. Pratima is saying no. Pooja is saying no. Very good. Why? Because that will again become other income. And can you tell me which standard would cover this transaction? We discussed this yesterday. Which standard would cover this? Very good. Pooja is saying AS 11. Yes. Another example could be about any other realized gain. Okay, let's suppose if your liability gets settled, wherein the liability is written back. Okay, these are all not examples of revenue recognition. So now let us try to understand as to what do you mean by revenue? Okay, what do you mean by revenue? Revenue, we can say, is the gross inflow of cash, receivables, or any consideration arising in course of ordinary activities. Means something which arises in ordinary course of business. And this could get generated from sale of goods. Say the company is having inventory. Now when the inventory is sold, so the sales which get generated, what would that be called as? Revenue recognition. Okay, let's suppose company is in the business of rendering services. What are those services? Say the company is providing consultancy services. So the revenue in respect of that, what do you call it as? Revenue falling under AS 9. Yeah. And the other part is if that is resulting into interest, royalty, and dividend. Okay. Now, in this case, one point one should remember is that if there is a sale between some branches of a company, if there is a sale between some branches of a company, so let's suppose there is a company, it has got 3 branches, branch 1, branch 2, branch 3. Now branch 1 is selling to branch 2, branch 2 is selling to branch 3. Okay, let's suppose sales of branch 1 to branch 2 is 10. Sales of branch 2 to branch 3 is 20. Now, should these branch sales be considered as part of revenue of the company? Yes or no? What do you think? What do you think? Pooja is saying no. What about others? What about others? Pratima is saying no. What about others? Ritika is saying no. Very good. See, when it comes to the revenue, revenue will be what? Revenue means the revenue which the company has generated from the customers outside the company. Okay? From the customers which are outside the company. So anything which is generated internally between the branches of the company, those will not be termed as revenue. Okay, and I think same response I've received from Preeti, Unikrishnan, Baswant. Great. Yeah. So this is revenue for us. Now, let us try to understand the revenue recognition criteria. So we have understood the meaning of revenue as to what this revenue really means. Now we need to understand as to when this revenue can be recognized by the company. So when would the company recognize revenue? And this revenue that we are going to discuss is currently limited to sale of goods. Means when the goods are sold, what is the criteria which the company needs to fulfill for revenue to be recorded? Or you can say only when this criteria will be fulfilled, only when this criteria will be fulfilled, the revenue can be recognized, otherwise not. Okay, so now a very important consideration around the revenue recognition happens to be the transfer of significant risk and reward in relation to those goods. What is the first requirement? That the significant risks and rewards which are attached to that particular item should get transferred to the customer. Okay. Number two, there should not be any significant uncertainty regarding collection of consideration from the customer. Okay. So these two, you should say, are the most important considerations for an entity to look into while recognizing revenue. Okay. Yeah. Now, for this, I think we can take some examples around this. So let me just pick up some examples. Okay, and you need to answer that. So let me just go to the working file now. All right, so let's suppose there is a company which is into the business of, so let's suppose there's a company which is into the business of trading of electronic equipments. Okay. Now, what are the terms? So company has a term with the customer that the company will be required to deliver goods at the location of the customer. Okay. Yeah. So what is the term? That the company will be required to deliver goods at the location of the customer. So now, so this is the situation that we have. On 31st March 2024, sale has taken place. Sale means invoice has been generated. Invoice has been generated. But what was the term of the contract? Term of the contract specified that when the goods will be delivered to the customer, that is when the significant risk and reward get transferred. Okay. And only then the customer will become liable for the payment. If let's suppose in transit, there is a loss, the goods don't reach the place of the customer, then the customer will not be held liable. Okay. So that is the term. And let's suppose it will take 2 days. It will take 2 days. So let's suppose it will reach on 2nd April to the location of the customer. So the goods will reach the location of the customer on 2nd April. So that is when the significant risk and reward get transferred. Now, in this scenario, there are a couple of situations which are going to arise. One, we are going to look at financial year 23-24. Why? Because in this financial year, invoice has been generated. Okay. And then we can look at 24-25, in which the goods have got delivered to the customer. Now, the question for you, what do you think should be the revenue recognition criteria and basis which company should recognize revenue? Means in which year company should recognize this revenue? Should this revenue be recognized in 23-24? Yes or no? And with reasons, please. Over to you, everyone. I'm hoping you have understood the question. So in which year this revenue will be recognized and why? Over to you, everyone. Yes, I'm waiting for a response. in which year this revenue will be recognized by the company and why. Should this revenue be recognized in 23-24 or not? And if not, in which year? Okay, so very good. So this response comes from Unikrishnan. Unikrishnan is saying 24-25 is the financial year in which the risk and reward get transferred to the customer. Okay, so that's why in this year, this revenue should get recognized. What about others? Over to you. Everyone, please try to answer this. Tell me. Okay, great. So I can see this one more response coming from Shivanna. Shivanna is saying revenue should be recognized on the basis of the invoice which has been raised. So it should be 23-24. Then I think Baswant is saying, sir, the seller has the responsibility till the goods reach the place of the customer. Hence, it should be 24-25. Then I think Pratima is saying 24-25 because the customer gets the ownership in 24-25. Then I think Ritika has also responded to this. Ritika is saying 24-25 because the conditions have got satisfied in 24-25. And I think same is the response from Pooja also. Preeti is saying 24-25. Very good. So now in this case, let's try to understand. See, one could be the administrative thing. So if you look at the company, they have no doubt generated an invoice. But can the company recognize revenue on the basis of generation of invoice? The answer could be yes, if that was the criteria as per AS9. But in that AS9, did we read anywhere that generation of invoice will become the criteria for revenue recognition? No. So what did we discuss? We discussed a couple of criterias. Most important one is that transfer of, sorry. So what is the first criteria? Transfer of risk and reward. And the other one was there should be no uncertainty as regards the collection. So that's why in which year this revenue should be recognized? 24.
मैं एक मिनट लूं क्या?
Sure, sir.
मैं क्योंकि shortly I may be joining a seminar physically.
Sure, sir. Sure.
So Achal ji, first of all, congratulations to you, doing very well. Good morning, friend.
Thank you, sir.
And Asha ji, Ajit Kumar ji, yeah, CA, Dr. Rasmi, Goel, and the whole team. My request to the students is please correlate all subjects when you are studying. Like this subject, I have just joined, but what I understood, sir is discussing AS9 revenue. Achal ji, are you discussing AS9?
Yes, sir.
So if we combine this with the Sale of Goods Act 1930, what we have studied in business laws in foundation, and even if we have not studied, we should look at the Sale of Goods Act 1930. So because sale is complete only, and the accounting standards are more real. Like in this AS, we are not studying the discounted value and other things. But when we will study for final the Ind AS, everywhere we see what is the value as on hand today. If we have sold a goods where buyer is going to give after 2 years, then we discount that value and record the sales at the value which is there today. So, all accounting standards. Achal ji, are you going to group accounting standards into elements of financial statements like assets, liabilities and expenses we group together?
Yes, yes.
Income, expenses, then disclosure, then the standards of consolidation, standalone, and interim. Like in assets, we will take the impairment also, and things like that. Then see, accounting was written in 6 lines, double entry bookkeeping by Luca Pacioli, 2,500 years back. So he wrote No, it is 1494, so not 2500 years back. So, personal, real, nominal. So, any questions, students, anything? I want each one of you to get 95 out of 100. Any questions? And we should focus on conceptual understanding. If concepts are clear, see, in accounting, we don't look at the legal ownership like leases. If it is finance lease, it is recorded in our books. And now, with intangible asset standard in place, AS 26, we do not have something called deferred revenue expenditure. Either it is an asset. So, look at the framework of the accounting standard also. What is an asset? Asset is the resource controlled by an enterprise, which is going to give a future economic inflow. And the liability is the present obligation, where there will be economic outflow. आप लोग कोई सवाल ही नहीं पूछ रहे हो. और आशा जी, हम थोड़ा अभी हमने फ्लायर बनवाया है, कल मैंने देखा मेरे ईमेल में. लाइव वर्चुअल क्लासेस का पब्लिसिटी करना चाहते हैं, क्योंकि हम इतनी मेहनत करते हैं, अचल जी इतना सिखाते हैं, और 15 स्टूडेंट्स हैं, क्योंकि 18 टोटल जूम पे हैं, जिसमें 4 लोग तो हम ही हैं, आप हैं, अजीत है, तो 14 स्टूडेंट्स से हुए, 16 है अभी.
यस सर.
तो
स्टूडेंट्स ऑन पोर्टल
नहीं, पोर्टल और अजीत जितना वाइड पब्लिसिटी, हमारा सोशल मीडिया है, ट्विटर है,
यस सर,
हमारा एग्जाम के पोर्टल में भी हम डाल सकते हैं. चलो कैरी ऑन अचल जी, कैरी ऑन.
श्योर सर.
क्योंकि स्टूडेंट्स कोई सवाल नहीं पूछ रहे हैं, बोर्ड ऑफ स्टडीज से रिलेटेड कोई भी सवाल हो. और अजीत, हर क्लास में मेरे कॉन्टेक्ट डिटेल डालो कि चेयरमैन इज वेरी पैशनेट टू talk to any students. They can WhatsApp their query related to anything. And Achal ji, we want 10 model papers for September 24 exams. Asha ji, you can talk to him separately.
Yes sir.
Either faculty, BOS faculty should do, or we should get it outsourced.
Sure,
but
sure.
It should be done at the earliest. Okay, thank you. Please carry on.
Thank you, sir. Thank you. All right. So students, coming back to the topic that we were discussing. So it was about the revenue recognition, yeah, in the context of sale of goods. So I understand, you must be looking around this time frame, because we are just, sort of crossed the time for today, but we are just going to wind it up. And the part of this revenue recognition is yet to be completed. So we'll pick up that part in our next session. And in the next session, we'll also be picking up AS 12, AS 14. So I would request you to come prepared with those topics along with this. Yeah, so we plan to cover that. As regards the part that we have covered so far, I think we can now discuss any doubts, any questions that you have, and then we can just close our discussion. Okay. So any questions, any doubts from your side? So I can see a couple of queries coming in. So Unni Krishnan is asking if the movement of goods is in the, I think Unni Krishnan, you need to clarify on this query. I am not clear on this. Then Shivanna is asking, in the case of transfer of ownership takes time, the invoice can be raised post that, and pro forma invoice could be raised while sending material. See, in raising invoice, pro forma invoice, actual invoice, e-invoice, all of these are what? These are administrative things. You need to go by the revenue recognition criteria. Yeah, so invoicing is not a revenue recognition criteria. So you just ignore that aspect. Fine. Ritika is asking, all the conditions have to be satisfied? Yes, of course. All the conditions have to be specified. Preeti is asking accumulated profit. So I think accumulated profit that I was discussing was in the context of tax losses. So let me just go to that file once again. And explain you as to what was that accumulated profit. So if let's suppose a company has been incurring losses year on year. So say this was year 1, there was a loss, year 2, there was a loss, year 3, there was a loss. So we discussed, let's suppose in these 3 years, company has incurred a loss amounting to say 80 crore. Okay. Now, in the future years, company needs to find out, in the future years, company need to find out that whether the company will be able to generate profits through which these losses can be adjusted. Okay, so that is what I think we were discussing in the context of tax losses. So this was not really accumulated profit, these were accumulated losses, okay, and which are required to be adjusted against the profits of the future years. If the company can do that, okay, therein we discussed that there is a requirement of the standard virtual certainty supported with convincing evidence. If that criteria is fulfilled, revenue, or sorry, that DTA can be recognized, otherwise not. Okay, then I think Uni Krishna has a query. He's asking, sir, if the movement of the goods in the role of corner, see, again, your query is not clear, but I can understand the thing that you're just trying to check. See, every time, what do you need to find out? You need to look at the cutoff. So there was a reason why I picked up that 31st March date as the cutoff, because 31st March is the last date when you can recognize revenue. So if on that particular day, criteria for revenue recognition is not met, let's suppose if that shifts to 1st April or to 2nd April, so you'll not be able to recognize revenue in 23-24. But for any reason, if the entity is able to recognize, meet the criteria of revenue recognition up to 23-24, up to 31st March, then of course revenue will be recognized in 23-24. Okay. Rashmi is asking, sir, MAT concept as per AS. Okay, so I think you are talking about this illustration, illustration 2. See, MAT, I think I'll have to just pick up that illustration once, and if there is any other illustration, Ritika is saying illustration 6. So let's do one thing. So I'll just make a note of these illustration. I'll have to just, keep this document handy. Maybe in the next session, I'll just discuss these couple of queries with you. Okay. On illustration 2 as well as 6. In the meantime, I have this query coming from Harish. Harish is asking, sir, in case of export, when did the revenue, when do you recognize revenue? At the time the goods reach the customer's place? See, again, whether it's about exports or the indigenous sales, it doesn't really matter. Every time, what do you need to find out? The terms and conditions with the customer. So what are your terms and conditions with the customer? If the terms are such that you need to deliver the goods to the customer's location, then of course, that is when the significant risk and reward get transferred. So every time you'll have to go by the terms which are agreed with the customer. Sangeetvani, the next standards, as I discussed, which are going to come up will be AS12, AS14. So that means about amalgamation. So these are the things you should read. Then Uni Krishnan is asking, sir, for terms and X factory gate terms for, see, FOR terms or X factory, or if we talk about CIF, see, these are all terms, and these are all terms which have been established in the context of business practices. So there's no doubt there is a relevance to them. We'll be discussing some of these terms also as a part of our discussion, because we are not yet done in terms of revenue recognition. But once again, on that point, I'll clarify once we'll be covering that whether it's FOR, whether it's CIF, it really doesn't matter so much. What matters is your term and condition, which is specified in the contract with the customer. That is how you need to look at it. Okay. All right. Any more questions that you have? Any more doubts that you have? No? All right. So then I think we can close our discussion for today. And in the next session, we'll be covering this remaining part of revenue. And of course, we'll start with AS12 and the amalgamation. Thanks everyone for your time and for your wonderful participation again. Thanks so much.
Thank you, sir. Thank you, sir.
Thank you.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you.